All right, so some just basic stuff first. We have a lot of new people here tonight. If you can, just scan the QR code or make sure you go to the sign-in sheet up there, put your name on it. This way you can keep updated for future events. Tonight we have our speaker, Todd. Todd basically was able to leave, well, he left his corporate job, he became an entrepreneur, and then transitioned to real estate, and basically got his freedom back. So I want to go from the beginning and talk about, what would you do for a corporate job first?
Sure. I will say what Nick said about you get your freedom back as an entrepreneur. It's you still got to do a lot of work. I don't know how much freedom, you get your time freedom for sure, but no, you're definitely tied to it. Appreciate everyone coming out tonight. Looking forward to being here, kind of share my story a little bit, and hopefully you guys can learn a little something. But to get to the beginning of, can you not hear me?
No.
I could talk louder. So you guys, because can you hear anybody? I mean, I could just stand up and start shouting if you want. But yeah, listen, I've only been real estate full time for about 4 years now. Similar to a lot of people, my story starts really back into the corporate world. I went to school and did the traditional. I got a job at a college, was working in the insurance industry. Really didn't know what I wanted to do, but I was like, okay, this is just what everyone does, and it's get a job, and that's, I guess for the rest of my life. But after a few years, I kind of realized I was hoping there'd be a different way to do things, and I was looking at how can that be done. And it wasn't real estate. At that time, in early 2000s, real estate wasn't even something I thought was possible. I really didn't know what to do. It was more a business. I had a little bit through my parents' background of the business world, and kind of said, okay, what about, can I open a business or do something along those lines? So my fiance, now wife at the time, she was really the catalyst to that, in looking to potentially get out of both of our corporate jobs, and which led us to opening a franchise, an Anytime Fitness franchise. So we lived outside of the Philly area in Montgomery County, Collegeville, if anyone knows where that's at, like Collegeville, Limerick area there. And we literally took all the money that we had saved up our first couple years of marriage, bought a franchise, and just sunk it into that business, going, this is great. I'm going to own my own business, and I'm going to be a millionaire. Little did I know, owning your own business, it doesn't work that way. It was like 3 years of struggle, and 3 years of a lot of hard work to get that business successful, that for our first location. So we opened that location in 2008. And then, as Nick said, what led to corporate, freedom from corporate life, I'll tell you, it wasn't that business. It wasn't opening Anytime Fitness. I wasn't able to leave my corporate job because it really wasn't making enough money to afford me to leave a corporate job that offered health insurance, that paid a really good salary, had a company car. So I had to maintain that. But what it did allow us to do is, as our family was growing, it allowed my wife to leave her corporate job. So, that business and being an entrepreneur and open that franchise eventually led us for her to leave her job. And then I stayed in the corporate world for about another 10 plus years, for me, that I continue to grow in that career, as well as operate our business. And then our franchise, we expanded into multiple locations, opened one up in the Poconos in Broadheadsville, and continued to grow that side of the business before entering into real estate.
And how many of those locations do you have now?
So I'll back up. We only have one. So we ended up growing, increasing. We opened up 2 locations, and then had a third. Decided, listen, having a young family and having multiple gyms and businesses was probably going to be a little too much for us, or what we wanted to do, because we wanted, again, as we were growing our businesses, it required, when you said, hey, time frame, we had to be involved. And so it was starting to pull me away along with a corporate job. So we ended up selling our Collegeville location, and then just ended up keeping our current location up in Broadville. So we only have one gym now.
Okay. And then at what point did you leave the corporate job?
Yeah, that's a good question there. So fast forward a couple of years, we have our gyms doing great, or 2 of them. We sold one. We have our one location is doing really, really well. But I was starting to, in my corporate world at the time, I was now a consultant. So I was doing a lot of traveling in the insurance world. I was managing basically from the Northeast all the way out to like the Mississippi River. I was doing a lot of performance management consultant for insurance companies, and I was traveling a lot. So it was pulling me away. You know, my goal of opening a business and trying to get out of my corporate job was so I could have time freedom for my family. And unfortunately now the corporate job was pulling me away from that. So the transition to real estate really started a hard conversation in like 2018, maybe a little before that. I had just gotten back from a business trip. I got back, I flew in, we left for vacation with my family to go to the beach. We're driving to Cape May. I vividly remember this, having a conversation that at the end of that week, I had to get back on a plane and fly to like Columbus, Ohio. And I was like, telling my wife, I was like, listen, this is like getting old. Like I need to, like, I don't want to do this anymore. It's pulling me away. We have a business that's growing. I was like, in the meantime, in the last trip, I was like, I found this great site called Bigger Pockets. We were talking earlier. It opened my world to what's in real estate, like rentals. I knew a little bit about that because being in the insurance world as well as an Anytime Fitness owner, the most successful agents, like insurance agents that I would go and do training or go to their offices, I'd show up and they would be I'd go to New York a lot. I'd go up to Connecticut. I could be in Philly, and they'd go to like these brownstones or these buildings. Ground floor was an insurance office, but up above was all apartments. And I'd be talking to these agents and they'd be like, you know, I make more money on my rentals than I do owning my book of business for insurance. And I was like, get the heck out of here. Like, yeah, I'll never sell this building. I'll keep, you know, even if when I close or sell my book of business, I own the building, and the next agent who buys my insurance agency will have to pay me rent. So that was kind of my intro. And then I'd go to these Anytime Fitness conferences. And as a franchise owner, we typically lease space in shopping centers. You guys may have seen some like Anytime Fitnesses or other, type of gyms. We lease the space. But the most successful owners, again, they owned the real estate. I would be talking to them and they'd be like, well, we own our building. And then I have tenants that pay me rent. My business pays me rent. So they're kind of like getting income from the business, but they're paying themselves rent because they own the shopping center. And that was, again, led me down that path of like real estate's the way to go. So I started exploring that. And that was kind of the catalyst.
Now, just to back it up a little bit, for anybody looking to get into real estate, Bigger Pockets, it's basically biggerpockets.com. It's an online forum. It's a good way to get information if you're just starting out. There's pretty much all kinds of information on there. They have calculators. They pretty much offer everything, and there's a membership and everything. You can pay for like a premium to get access to some other stuff. But it's a good start for anybody looking to get into it. Backing it up now, Todd.
Yeah.
So obviously you heard real estate was the way to go. What was your next step? What were you looking into as far as real estate?
Yeah, at that time I really didn't know what I needed to do or how to do it. And it was more for me using those resources, whether it was people I potentially knew, it was online resources like Bigger Pockets or YouTube or forums. And in that same conversation, going to the beach, the story I told about with my wife, I told her, listen, give me 6 months. Give me 6 months to figure this out if it's doable, if we can dive into real estate. And if we can do it, we're going to do it. If not, I'll dive headfirst into the corporate world and just continue to do that. Literally 5 months and like 18 days later, I bought my first rental property in Allentown. And that was the start of it. It was a single family home.
And what kind? Okay, so single family home. Was it what was your goal? Were you looking to flip? Were you buy and hold?
No. So I was in doing all the research, my goal or what I ultimately wanted to do, I was going to be a buy and hold investor. So looking at the different avenues, whether it's wholesaling, it's fix and flips, whatnot. I was like, listen, long-term wealth generation is what I wanted to do. I wanted passive income. So I wanted cash. So I needed to generate some cash flow, right? To make up for my corporate job if I was going to leave that. And then 2, what's the long-term play there? I'd rather hold this asset for a period of time or a longer period of time for increase in value there for wealth. So that was my goal in doing it. Again, starting small, it was buy a single family home.
Okay. And what kind of single family was it? Did it need fixing up? Was it a turnkey?
No, it did. It was a 3-bed, 1-bath. So what I also did is areas to learn from it. I started going to meetups. So I started going to meetups like this. I looked for the ones in my area, started going to meetups, meeting people and connecting with other investors who are already doing it. And I was like, all right, I got to learn from these people because they're already doing it. And at the meetup, I met a realtor. I was like, hey, I'm looking to do this. She was like, I have an investor client who's an investor, owns a lot of properties. He's looking to unload some single family homes. They're not in the best of condition, but would you want to look at them? I was like, absolutely. Let me take a look. And that's kind of the connection that I made through an offer out, and he ended up selling it.
Okay. You want to talk a little about how you funded that deal?
Sure. So that deal, I'll go back to kind of when we funded our business. I said to my wife, listen, I think we could do something here, but I need all our cash that we have saved up to buy this property. And she's like, you serious? Like, this is what we're going to do? You're going to take all our money? And I was like, yes. But I was like, I think it could be a good thing. It could be the catalyst. So she ended up, yeah, let's do it. So it was a cash buy. It was literally taking all our money and said, let's go buy this rental property. And that's how I funded that first deal.
Okay. All right.
Yeah.
How many lenders do we have? I know there's one right now. Is there anybody else that's a lender? So we have two?
Yeah.
Okay. All right. Those are the people you want to get with if, you're looking to get a property. There's tons of options out there besides the 20% down that everybody thinks. So
yeah,
if you're looking to get into this business, you might want to consult with them and see what options there are out there, what tools you can use to get into some of these properties, especially distressed ones. They tend to be a little bit easier, but obviously there's some work to be put into them.
To be heavier lifts. Yeah.
Yep. All right. So where'd you go from there? Okay, you got your first one.
Yeah.
You held on to it. It sounded like it grew pretty quick from there.
We did. We held on to it for a while, and then I continued to buy some. So basically, for anybody who's not familiar, there's a term called like the Burr method. That's kind of what I did on the first one, right? I bought it cash. We fixed it up. We got some good tenants in there, increased the rents on it, made it really nice. I was able to do a cash out refi down the road. So then now I was just using cash to buy the next ones and kind of go from there. And that's what I did. So for the first year, I bought 3 single family homes. Year 2, I said, all right, I want to let's try to double that. But I was starting to buy small multifamilies. The guy I bought the house from in Allentown, he had my first property. He had 400 properties or 400 doors throughout Allentown and Bethlehem. And we close on the deal, and he says to me, he was a young guy. He was younger than me. He was like in his early 30s. I was like, get the hell out of here. Like, how are you doing this, man? And he's like, he started doing it right out of college, right when the 2008 market kind of crashed. So he was just gobbling up a lot of stuff in the valley. But he says to me, he goes, listen, one piece of advice, it's like, get out of the single home business and go multifamily. He's like, that's how you're going to scale. You're going to make the most money doing that in cash flow. And I was like, well, thanks for telling me that now, as I just bought a single family home off of you. And he goes, look, you could have 50 single family homes. That's 50 roofs, 50 water heaters, 50 individual tenants spread out all over. Or you can have a 50-unit apartment building. It's one roof and all the water heaters are in one place. And if something happens, your maintenance guy only needs to go to one building. He doesn't have to drive, or your contractor have to drive all over to make repairs. Because plus, if a tenant, like you have to evict the tenant, you have to leave in that home, in that single family home, guess what? You're making no money until you get a new tenant in there. But if one tenant leaves, you have 49 other tenants that are still paying your rent, and you could probably still pay your mortgage. And that was kind of the light bulb early on that I was like, all right, that's kind of where I want to go, but I need to learn first. So I'm a very let me understand the game before I get into it. So I continued to buy single family. And then I was like, all right, I'll buy a 3-unit. I'll buy a 3-unit. Then I'll buy a 6-unit. Okay. And kind of
so you transitioned into it.
Yes.
Okay.
I graduated a little bit, then going right from one single family to buying an 88-unit apartment building.
Okay. Now those properties, were they distressed as well? Or?
Yes and no. I mean, by distressed, so I was a value add. I always looked for value add. So I looked for properties that probably cosmetically needed upgrades, but I wasn't going in doing heavy rehab. I wasn't going in and stripping it down, new plumbing and electrical. I would do new upgrade electrical. So we would do electrical, but it was usually semi-heavy value add, where new floors, new cabinets, make it really nice, do the exterior roofs and siding, and then go in there and place new tenants, or keep the tenants and just able to gradually increase market rents.
Yeah, what you'll find out, I think, when you get in that market, is a lot of the landlords get tired.
Yeah.
They just get used to it. They probably have, I mean, listen, some just have one building, some have multiple buildings, but they have that cash flow coming in. They don't bother the tenants or anything. They don't change the rents or anything. They don't renovate. So those are all opportunities for somebody new to come in. There's things online. We can find out the rents, what the estimated rents of the property are. It's a way to run your numbers. You could see, if some right now might be renting for $900 a month, and you can get $1,300. There's your value add right there. You rerun it with the new numbers.
Yeah.
Offer the guy a low, offer on the house, and there's your add value to it right there.
No, for sure.
So let's talk a little bit then, after you've scaled up from there. Let's talk, when did you start Summit Capital?
Yeah, so you kind of continue the story and trajectory there. What happened is, as I started to grow, as I mentioned, I used a lot of my own money early on, bought stuff cash that I had, those single family homes. But when you started getting a little bit larger multifamily, it wasn't going to be feasible. One, I realized you run out of cash real quick. And I was like, I can't keep taking all my own money or trying to figure, not having anything personal savings there. So as I started getting to a little bit larger multifamily still in my personal portfolio, what happened is I started getting outside investors in. I realized, okay, I need to come up with more money. And again, started friends and family, saw I was starting to buy multifamily, and would come to me and said, hey, can I get into investing a little bit, or can I invest with you? So that was kind of the next catalyst as I started to scale, was able to get outside investors to come into deals so I could buy larger multifamily. And it started on a 6-unit, started on a St. Luke's medical building, on a 13-unit. I was able to get outside investors, friends and family, to basically give me the money so I could go buy it, not cash. I'd have to obviously finance those deals, but they would provide a good chunk of it and some of the rehab money. Those deals I did all as joint ventures or JVs. So they're a partner. It wasn't even like short-term loan
syndications or anything.
No. This was all joint. This was all joint ventures. So, but that was my first intro into raising capital.
Okay. That
led me into now starting to get into, okay, wait a minute, larger apartment buildings, like large scale apartment buildings where we could potentially syndicate those deals, which is really just pooling investors' money together as limited partners to buy large apartment buildings. And to do that, again, as I mentioned, I need to learn and understand it before I dive into it. And I'm a big fan or proponent of educating yourself and being in the room with people that do it. And for me, it was joining mastermind groups or groups of people that were buying large apartment buildings. How do they structure it? How do they fund it? How do they acquire capital or raise capital? And that's kind of what led to eventually now the company that we have called Summit Capital. I joined a mastermind group for basic multifamily investors, small scale, that were looking to scale up. And through there, I found a business partner. We did kind of 2 deals as part. He had his own company, and I kind of had my own thing. We kind of aligned in values and vision. We did 2 deals together. We said, okay, you're already raising capital for your deal. I'm raising capital over here. Let's see how we work together. We did those deals, worked really, really well. Kind of what he was good at was my weak areas, and what I was good at was his weak areas. And then from there, we decided to turn it into an actual company and now start to syndicate apartment buildings or partner with other large operators where we can raise capital and be asset managers on those deals.
All right. Can you explain syndication a little bit to people that aren't familiar with it?
Sure. Just real quick and easy version of it. A syndication is a group or a person might go out and find a larger apartment building that they're looking for investors. So there's a general partner and a limited partner, and they would go out and find limited partners, which everybody here could be an investor in a real estate deal. You're a part owner in that, but the general partners are the ones who find the deal. They're going to put the deal together. They're going to manage the deal. They're going to, potentially sign on the loan or find
they have full control over it, essentially.
Yes. They're controlling the deal. You guys are just in
You're
it
just
for the
there
money.
for the return of the obviously to get into the investment, you're going to get a return at the end or whatever the strategy is.
Yeah.
And that. All right. For anybody getting from here, how would you suggest someone that wants to get into real estate? What would be the first step?
Yeah. I again, just kind of backing up. Some people would say it took my time. It took a little bit longer. Just jump. If you know you want to start buying large apartment buildings, go for that right off the bat. I just from my business in the fitness world to opening our franchises. It took a while to us to finally open the franchise. If you're getting started, I'm a big fan of education, is coming to these right here, meetups, learning from other investors. Make sure you understand what you're getting yourself into, because it's great, be a landlord, I'm going to buy a rental property, but there's a lot of things, as Nick will tell you as well, and people here who've done it, there's a lot of surprises. So make sure you understand what you're getting into, because everyone says, oh, real estate's guaranteed, it's a great return, it's a great investment. You can lose your money in it. You really can.
You can. You got to do your due diligence.
Yeah.
Like I said, really, go through it. But at the end of the day, you still got to dive into it too.
For sure.
You can't get scared away. I know I've researched. I don't know how many years of meetups I've gone to before really pulling the trigger.
Yeah. So take action. Take action. Educate yourself, and then at some point it is scary, but as you just said, you will have to pull the trigger. And when you're ready, you'll know when you're ready, and it's time to jump into it.
What do you do as far as continuing to grow as an investor? I know your mentor mentioned mentors.
Yeah.
Is that pretty much what you do? Are you into books, YouTube, podcasts?
Yeah, for me, it's continual learning, and not only just in real estate. So outside of it, I run a not a coaching group, but basically a mentor. I'm drawing a blank here.
It's common in this business for somebody, typically, if you want to grow, like I'm looking to take what I have right now to the next level. So really, it's common at this stage for me, somebody to get a mentor, basically somebody to guide them, kind of go through what you have, somebody who's maybe done it already, a similar path, and kind of guide you through it. It's common in this business. It is kind of pricey. It can be.
It can be. You could pay for coaching.
Yep.
You can, there's a lot of free groups. And when you're starting out, you're probably like, hey, let's start out for free groups. But like on the Anytime Fitness world, I run a peer group. So it's all Anytime Fitness owners. And there's no cost to that, but we're learning on the business side of things, on how to operate our club, from personnel, et cetera. And that helps me translate into the real estate world. I belong to a lot of groups that don't cost any money on the real estate side of things, but it's like-minded people that might be in syndicating. They might just be single family operators, whatever, but we try to meet up once a month virtually. I go to the meetups here are great. So we run a meetup as well.
All right. What do you think some of the factors to your success are?
Yeah, that's a great question. One, support. So I'll say number one is the support. My wife was the biggest supporter in all of this. And I mean, she allowed 2 different times to pretty much use up all of our savings to go ahead and do some business endeavors on there. So having that support. I will also say patience. Just in life in general, I tend to be a very patient person. But patience, what I mean by that is, it's not, your success isn't going to happen overnight. It's gonna potentially take some time on there.
Snowballs. Yeah, it's a slow. There's people that hit it good, but typically it's a snowball effect.
Yeah, be patient. And the challenge, I think, early on for early investors, like anybody in here who's looking to just get started, or like, let me see what's going on, is you might come into this room and you talk to Nick, or you talk to me and or anybody else that might be here that already has a large portfolio, and you get caught in that trap of, Jesus, man, I should be doing more. Why don't I have 10 doors? Or I would meet people and be like, dude, I didn't get any apartments. I know someone who's already got like 5 different properties. And it's like, what the heck? I should be further along. It's okay where you're at, and in time you'll get to where you're supposed to be.
All right. In the next few years with real estate, where do you see it going? I mean, none of us have a crystal ball.
No.
But what's your thoughts?
Yeah. Well, I hope it's going to like lower interest rates, not so much compressed cap rates and things like that. But I think you're going to see a lot of technology. I mean, technology is entering every space. It's going to be heavy in real estate. There's a lot of like early players. We're just talking short-term rentals up in the Poconos and things like that. There's a lot of companies that are leveraging technology to get into the short-term rental game. You're going to see a lot of technology just in the management. It's already there of rentals, but large-scale portfolios. So I think you're going to see potential for apartment investors, maybe some chance to reduce costs from property management standpoint because of technology, which will impact property management companies. I think you're going to see a lot of retail money. You already saw it with like BlackRock and those guys coming in, getting into there. So you can see a lot of capital come in. And unfortunately for, I think, smaller investors, we see it in the markets that we try to acquire apartment buildings. We're getting squeezed out because for value add guys like us that are bringing in like everyday investors that are coming in, I have to achieve a return for our investor. But if you got someone that's dumping a couple hundred or $1 billion, and really it's across a whole large portfolio, all those properties can perform, and then for their hedge fund, they can still hit their return. But when we're buying one property and not like 35 massive apartment buildings in a market, that's a little challenge in certain markets right now.
Okay. All right. And then I want to finish up is how has your investment philosophy changed over time? I know you started off small, went big. Would you change anything? Do you still want to keep growing with Summit Capital? Do you still want to keep building your own portfolio out?
Yeah, I mean, my investment philosophy hasn't changed in regards to long-term. I'm still a long-term buy and hold investor personally. So just for long-term wealth generation, that's my goal. That is still, so I buy properties, I still hold. Other than the only properties I've sold in my personal portfolio has been my single family homes. So I got out of that game because they were I will be honest up front, they were challenging to vacancies. You have some damage or a loss on there and everything you made in a year is gone and you're negative. I was not always, but you were negative on those single family homes at the end of the year because they just ate up a lot of your cash flow. So for me, I'm still continuing to buy in my personal portfolio, but it's got to be multifamily. And I would like to buy something 20 for me personally, 20 units and less. Now my company with Summit Capital, so we look for 25 units and larger. We manage and we'll buy up to probably about 100 units just because in our price point on the capital we have or what we can raise, that's probably under $15 million in the markets that we look at. And we'd be able to manage that. We also have strategic partners in other markets that will co-GP, so we can still come in and partner. But if we don't know that market and we don't have, an operator there, we'll partner with an operator that's already there.
You are nationwide.
Correct. Right. Yeah, I mean, not nation. We're in a handful. We select markets: Columbus, Ohio; Greenville, South Carolina. We're in Scottsdale, Tempe, Arizona, is where we own properties. Is where we have. So that's kind of where we focus. We'll go into other markets if it makes sense with a partner that's already there.
Okay.
Yeah.
All right. Does anybody have any questions for Todd?
Yeah, listen, you guys have any questions though?
So when you're syndicating, right?
Yeah.
So as an individual investor,
Yeah.
Is it, I guess you're just getting a percentage, fixed rate, start on your money, or is it?
Yes and no. Yeah, so that's a great question, Dom. It's basically, so on a syndication deal as an LP, so I'm an investor myself, LP. I just do this as I invest in with other operators across the country. So you come in as what's known as a limited partner. Typically, it's either 25, 50. I mean, they have different class levels you can invest in there. Most operators will do what's called a preferred return on that. So they guarantee you, like when we have an apartment building, we'll guarantee, hey, if you invest with us in a Class A share, and I just use simple math, it's $100,000. So if you said you invest with me in $100,000, typically our pro formas and what the material that we would give to a potential investor will show this is what you can expect your annual return, what your cash flow will be. And then when we sell the property, our business plan is we want to renovate all these units. And then we know our rents can go from $1,000 a month, and in 5 years we'll be at $1,500 a month. And then the NOI, net operating income on that, will be X. We can then sell it because the market and for realtors, you probably know this, but they value multifamily apartment buildings different and how they appraise them different than just like your homes. It's not like, what did that sell for? Because there's not a 300 unit apartment building next to a 300 unit apartment building that's sold. So it's based on your cash flow and the market cap rates. So we can predict literally what that exit will be and say, hey, the profit then will be $5 million. And based on your ownership percentage, then you will get a percentage of that. The typical splits that come in are what's known as like 80-20 or 70-30. So what I mean by that is the 8%, they might give you an 8% pref. So if you, simple math, you invest $100,000 a year, you're going to get minimum $8,000 in cash flow that will be distributed to you, okay? Once they achieve that target, again, I'm going to try to keep it simple. There's different, like what they call waterfall models, and I don't know how far you want me to get into this, but to answer your question, then you'll still get more money on top of that. That's just your minimum. And then yes, yeah. But in the annual cash flow, so you're going to get 8% on that money. And then if there's additional money on top of that, it's an 80-20 split. So what that means is the investors get 80% of the additional cash flow, and then us as the GP team will get 20%. And that's how we're getting paid. You know, we also invest our own money in those deals, but that'll how it works. Now, you know, again, we can talk more after this, because typically year one, as much as it's 8 pref, if the operators miss that, it's catch up. We do eventually, oh, well, let's say we only pay you 5% in year one. Year two, I got to pay you 11% before we make a dime on that, you know, or any money comes to us. And then yes, at the sale kicker, then when they're selling, there's $5 million in profit. We have to pay back all your principal first. So before any money gets distributed, so everybody's initial principal gets paid out, so your 100,000 goes back to you, then you're going to get the next 80% of what's remaining goes to investors.
Yeah, it's a real good way to invest passively.
Yeah.
You don't want it, all this sounds overwhelming, dealing with tenants and everything else.
There's tax benefits. Like if you're really
it's
looking for like, hey, I want to invest in real estate, I want the tax benefits, I want some cash flow, and potentially, you know, to double, or, you know, there's an equity multiple in there over a handful of years, and you don't want to actually buy your own place, a single family or a multifamily, and deal with it, that could be a way for somebody who's a passive investor who still has a good W-2 job and you're looking to diversify your portfolio. That might be something you guys want to look into. Because that's kind of what I did. That's what, you know, I invested there first before doing an actual syndication.
Got it. Wayne?
So, are you always selling property in the end?
Yeah. So on the syndication deal, because now I have investors' money, I have to get it back to you guys. We do some joint venture deals, and that's kind of what I mentioned early on. That would be where we get a couple investors. We don't syndicate. It's just like, hey guys, we're looking to buy this apartment building. I'm looking for an investor. We're going to hold it for a long period of time. Would you be interested? That's different. But in the model, in a syndication model, they're usually selling anywhere from 3 to 7 years, because we got to get your money back. So you're going to get cash flow during those years, but then they got to sell to give you your principal back. Yeah. Yeah, a typical holds 3 to 7. You know, be upfront with you right now. The way the market conditions are, it can go longer.
It can go longer.
It can go longer.
So just so you know, there is an exit strategy, but if it's not ready to deploy, they'll hold it longer.
There's a lot of operators.
They have money to return to the investors. So,
yeah. And you're seeing that now with operators who had a business plan to exit in, like, hey, our goal is to exit in 5 years, and this is year 5. The market is not right with interest rates and cap rates, so they're just, you know, we're going to hold it another year. We're going to hold it another year. So there's no guarantee they'll sell in 5 years or 7 years. It's typically when the last 3 years prior to this, people were buying places and they were selling within 2 years, massive apartment buildings, and generating returns that they were predicting would happen in 5 to 7 years. Yeah. That's a great question. Yeah, so I don't know if you answer it but yeah, it depends. For us, it depends. It's deal specific. So you may have to be an accredited investor or non-accredited investor, and what that means is, for anybody who's not familiar with that, the government, depending to be able to invest in a syndication deal, depends what type it is, what type the operator will set up, a 506B or 506C. You might have to be accredited, and that just means either your net worth or what your income level is. You have to be, because they consider you a sophisticated investor, which is stupid. Yeah, exactly. Even though somebody who makes a lot of money could be the stupidest person, doesn't know what they're investing in, and they can lose their money. But there are opportunities we have where we can take non-accredited investors into our deals as well. But it's going to be deal specific. Yeah, but yeah, it's a great question.
Anything else? All right, thanks Todd for your time.
Yeah, appreciate it, guys. Stick around if anyone wants to chat.
Stick around, we'll chat.